So we're getting a late start on Tyson, Halsey Income Growth Advisors. I've got Jennifer Warren, who's fairly the only woman here. So she's our energy expert. She will speak after Richard Gula and I speak. I'm going to try to move quickly. Jennifer says she has a 11:30 hard stop, 12:30 hard stop, 11:30 Central. Basically, we're in a very interesting period. And, what I've been saying on these calls for a while is I think that things are different. 4 decades of declining interest rates have now led to the bursting of 3 standard deviation bubbles in stocks, bonds, and real estate above the trend lines. And these bubbles unwind slowly. And it reminds me of the period after the 2000 bubble. And I think you have to look elsewhere. And frankly, had I looked elsewhere in that period from 2000 to 2008, I would be wealthier than I am today. I think that looking later at that period, I saw that small caps, value, basically everything that wasn't working, worked. That included the emerging markets and the like, gold, precious metals, commodities. And I think that we're in a situation which is quite similar. So to drive that point home, I have the Shiller's CAPE ratio. And what you have here is a market that is overvalued at 28 times the 10-year earnings average and a significant decline in interest rates. I think there's a way that I'm sorry, folks. All right, so we're back to this. Anyway, so basically you got 40 years of declining interest rates. They're going up. We have rising rates. We have inflation. We don't know where it's going to go. We think it's going to go lower. I think that'll go lower, but much slower. Here is another chart, but basically I'm a great believer in feedback loops and behavior. And now that declining interest rates have ended, we have some struggles ahead of us. And those struggles may be very beneficial to other areas. Another chart that I like to look at is one that compares the CRB ratio, the ratio of the CRB to the S&P. It was pointed out by Jeff Gunlock a couple of years ago, but his comment, I think, really resonates, and that is during periods where commodities are outperforming, the outperformance is significant. It's on the order of 700 to 900%. This is over several years, but that's massive. And I believe that we have begun a commodity cycle. I know Jeff Curry talks about a commodity super cycle, and I think that we are in that. Another way to look at what we're seeing, there's commodity inflation, but then there's just basic inflation. And this is an interesting chart, which shows when you go back 125 years, we have these kind of 10-year periods of inflation and deflation. And we went through a period of deflation, recently. I'm not sure whether that's that clear, but basically from 2010 to 2020, when oil got down to $12 or negative in the futures market. And now I think that we are due for a period of inflation. And one of the areas that I like in particular is gold. And gold, not just being a commodity, I think that gold, as it can sit on the balance sheets of central banks, makes it unique. Certainly, it's been around forever. It's non-correlated. It seems to be gaining momentum. And historically, it's been an excellent inflation hedge. So as we're looking at a world with a lot of uncertainty, it makes sense. The momentum is gaining. I've done a little programming of quantitative strategies. And, a lot of people just say, what is trending well with low volatility? And gold will now start ranking well. And again, as I mentioned previously, you get these feedback loops in the market, and strength will beget more strength. The fundamental case for gold, for stocks, benefits, one, from the appeal of the underlying metal, which I indicate it has momentum, it's an inflation hedge, it's a dollar hedge, it's a recognized currency, and technically it's ready to break out. But when you look at it as an asset class, I mean, the point is, you can buy a bushel of corn and say, oh, I got some commodities, or you could buy John Deere or Archer Daniel Midland. Likewise, the same can be said that, you can buy gold bars or gold coins, but you can actually buy the gold stocks. And in the case of the stocks, they're extraordinarily cheap. And in fact, it really reminds me of where oil was around 2000. And so basically, this is from Crescat Capital. I think they do excellent research in the gold space. That's their area of specialty. But you have historic cash flow levels. They're buying back stock. Their dividends are very high. Their cash levels on a per share basis, excellent, low PE. Mining as a percentage of the S&P 500 is at a low, and central banks are beginning to buy gold. And what we're starting to see is this. I wrote an article on gold back in 2019. It was around September, and I said, buy gold. They're starting to lead. And I was right. And I said, get out of it in in August of 2020, after the COVID swoon or crash. And what you see is the price of gold went up, ETF flows went up. And I think that what you're seeing here is that inflows into ETFs are occurring. I've shown on other slides that you have central bank purchases are rising. And Michael, let's see, I'm going to mute you. Let's see here. But I think that if you look at the previous move, you could see a bigger move in terms of gold. This is a historic chart just to give you a sense of the dynamic here. And I think that it is an unfair comparison to suggest in the 70s that that's a real market move from 35 to 677, which would be 1,800%, because frankly, gold was not allowed to be traded at that time. It wasn't a pure market. But it was a pure market by 2000. And again, when you had a move in gold, there it moved 600%. People can make a fortune on a 600% move. And I believe that if you're not allocating to gold now, you should definitely consider it, because a lot of research I read suggests, oh, gold can go from 2,000 to 2,200 or 2,400. I'm not sure in the next several years whether or not gold could go to 2,800, 3,000, 4,000, maybe even 5. But I just don't know. But I think that the upside there could be significantly underestimated if we go through a more difficult period in the future. We've got geopolitical risk, we got all sorts of stuff. The other thing to consider is that gold is inversely correlated with the dollar. And I think that there is an argument that the dollar is being debased by Russia, China, but I think that our own management of our budget is horrific, and that hurts. But frankly, I think everybody else in the world is doing a crappy job as well, and everybody's currency is acting very poor. And so I think that that's just going to feed, again, a feedback loop where money is going into gold. Here's a nice chart of gold looking to break that 2,000 level, and it looks like it could go higher. I know Carter Worth is a friend of mine, and he sometimes says, you will test a level a couple of times. So if it's on the downside, the third time, you see whether it breaks, but at some point it's going the other way. And in this case, this is we're the third time here. And I think soon, certainly this year, certainly probably in the coming months, you could see gold break out and So basically my theme here, the new normal is out with the old. Stocks, bonds, and real estate are not going to generate the returns that we've seen in the past. You long duration assets, bonds, growth equities, large cap, the 60-40 strategy, indexing, that's not going to reward you the way it has for the last 4 decades. And now I think we're in a period which is very much like the 1970s, or that small period between 1999 and 2008, when gold and oil really took off and the stock market went nowhere. I think we're in an environment where, you want to be in different stuff: gold, commodities, U.S. Treasury 2-year notes, emerging markets. But basically, money is going to go to where value is, and it's going to be a new leadership. I'm going to continue here. This is kind of interesting. This is a chart of gold versus real estate. And in that, what you see is a period when gold substantially outperforms real estate. Now, I come from the Hamptons, or our family has grown up there, and I've seen 100x type appreciation in real estate. It's happened during this period where we have had declining interest rates, and then there are other reasons for it to do well. But I think that the idea that gold could now do well, and so much money has gone into real estate, it's where a lot of people's money is. But I think the idea that now you could see gold start to outperform real estate is a provocative one, and people don't look at it. But, a lot of people feel very secure in their homes for good reason. But, I think that that adds to the argument. The emerging markets, they did brilliantly from 2000 to 2008, that inflationary period where stocks and bonds didn't do well. Not so much bonds, but definitely stocks. But then they've done poorly, and now I think that they're due to come back. And one idea that I have is that you can buy something like a Templeton Emerging Market Income Fund. Not a big fan of mutual funds and the like, but I think the concept's there. Here it yields 11%. They're actually buying back their own shares. But I also think that if you have strength in the emerging markets over the next couple of years, that could be thrown into a mix in a portfolio. And I basically say, I think I would prefer to own a mix of emerging markets, sovereign debt, plus, debt on bonds, over owning income vehicles based upon, let's say, commercial real estate. The other point that I want to talk to is I like to look at the growth value cycle. And I think, again, we are in a period where we're going from growth to value. And the point here is between 2000 and 2007, that was 7 years. I think that people need to say, hey, maybe tech peaked in January of 2022, 2021, excuse me. But it's going to be 2028 probably by the time all these hyper growth concepts really have lost their momentum and people are much more into big, heavy industry, or whatever constitutes value. Lastly, I was mentioning early on, a little chat comment here. Are you able to use full screen? Sean, if you can tell me what to punch to get full screen, that would be awesome. But try some. So Tellurian is a name that I've touted, and I think it's unusual. They are an LNG exporter. They're building the Driftwood plant. It's being built by the former CEO and co-founder of Cheniere Energy, symbol LNG. And I think that what we realized is that this particular, what I have here is a chart of Cheniere going back to 2000. And what I've identified is that between when they first started to fund and then build a gasification plant, the stock went from a half to 40, at 269% annualized type return. They actually then discovered, and Jennifer could probably comment more on it, a tons of associated gas with fracking. And suddenly the idea of taking international gas, turning it into LNG and gasifying it and spreading it to the US, their business model was upside down. So Sharif Stuki had to flip, and he then built a LNG facility, Sabine Pass in Corpus Christi. But during that period, the stock had a massive move. And the conclusion is that you want to own Tellurian now during this period of transition where they're trying to get their financing. They just got $1 billion lease back. They think that they are very close to getting $7 billion in project finance, and they're working on getting a couple other equity partners. And if they are correct, and I literally was on with an institutional client, Sharif Suki, on for a Zoom call right before this, they should be able to declare essentially getting their financing in order this summer. The particular sale leaseback requires that they have guaranteed funders in addition to the $7 billion, which would basically allow them to get to what's known as full notice to proceed, which is when Bechtel says, we will build the plant to completion, and they get their own skin in the game. But if that happens, I think the stock could be 7.5 this summer. It's currently about, I haven't looked at it today, but it's $1.30, $1.40, something like that, basically fivefold. But it could also be $34 when they start cash flowing in 2027, and 53 in 2029 when all 5 trains are running. We'll have time for questions after this. Rich Gula, fire away. Rich Gula, as I mentioned, he's worked for Dean LeBaron, well-known quant strategist, billionaire, and he's also worked at Bay Banks. He ran money there. He worked under Ned Johnson, doing special projects, set up the Fidelity Modern Chart Room. And as somebody who is went to Harvard undergrad and grad studying psychology, he's somebody who looks to how people are thinking about what's going on. He often and always has great insight. I was posting his charts, which he got to me a little later than I wanted because I had the Suki call. But here we go. Rich Gula, we can hear you, but all we see is the back of your iPhone. But
can you hear me okay?
We hear you just fine.
Okay, I didn't know if I had the microphone on. The first, if you do the first 2 charts, well, the first one, there were a number of commentators on this morning on CNBC talking about earnings, and they reported a couple of interesting things. One was that 81% of the non-financial stocks had beat estimates, but only 60% of the financial stocks. My favorite well-dressed bear, Stephanie Tomboy, got airtime again today. And I always listen to Stephanie because as long as she's bearish, there's a good chance the market will be going up. But I would never want to be responsible for her wardrobe bill because she and Christine Lagarde are the 2 best dressed women in finance, as far as I'm concerned. But she's very articulate. She just seems to have a bearish bias. And the right after that, they had on someone from CBRE, which is the commercial real estate group, and they showed all the commercial real estate stocks being up 5 and 6%. And that gentleman was pitching that there's nothing to see here, as we like to say in the cynical world about politics. And by the way, there were USB ports in all the Dominion voting machines, but somehow that's gotten lost in the shuffle. But that's what I hear. I don't know that for sure. Somehow that never came out in the trial with Fox. The what's interesting is that the negative folks out there have that earnings out sometime in the next 12 months, and that IBES is projecting 12 months forward, way down at 200, and you can kind of see that it doesn't seem to want to go down. And now maybe that will crash at some point, but at the moment, it's leading to the second chart. If you could change charts and go to the standard view of the S&P. This comes
Yeah,
from
interrupt. If anybody really smart can tell me how to get to full screen, I think it would help. You just have to unmute yourself. But go ahead. So here we got the S&P 500.
Yeah. That's from a very good friend, because I'm on the market technical analyst education committee. I will confess now, for the first time in a long time, I've never joined the Market Technicians Association, because I have always had a few problems with the approach that they take. That's more patterns, repeat versus junctures are recognized and then you reverse, which is a Dean LeBaron bias that I go along with. But Craig Johnson is the pretty well-known, seasoned technical guy out at Piper Jaffray in Minneapolis. And this is a nice conventional look at what he sees, and he sees what I see, which is that you see that big spike there in the middle of the chart, that low in October, and that you've started a cycle of some kind there. There's lots of evidence that shows up on a rotational basis in the charts that you'll see forthcoming. And it is disconnecting from a couple of things. Number one, it's disconnecting now from the Fed and interest rate increases. It's semi-disconnecting from earnings, and it's fueled by a sort of a mode of analysis that is clearly with the younger generation of folks out there. I just turned 74, so I'm qualifying in old fart status here. But there was a slide put up on the Meta earnings that said the older folks here may recall that we all read something called "Herd on the Street" in the Journal every morning. Now that's been converted in the modern vernacular to "Word on the Street" or "Words on the Street," and they did a word count of what Zuckerberg said during the call without ever mentioning earnings, sales, or revenues. And I was going to offer a $5 Starbucks card, whoever could come closest to the number of times AI was mentioned in Word on the Street. But given that I don't have that card, and I would be glad to send it to everybody here on the call. It was mentioned 47 times. And that was made a big deal of by the commentators on the Meta call. And Meta stock is up 30 points. That I'm not sure if that's more surprising than the fact that Chipotle was also talked about. And if anybody can come within a couple of percent of what Chipotle sells for, you're a pretty good market maven. But I'll just tell you, Chipotle sells at over $2,000 a share. And it trades. And it probably means that the ETF business is alive and well out there, regardless of what you may feel about the market at the moment in terms of earnings and so forth. But anyway, with that intro, we can go through a bunch of charts and we'll see what the market folks look at without admitting to it all the time. Next slide. This is probably one of the charts that, of course, a number of people have pointed to with a real, you want to enlarge, I'm not enlarging it, but M2, the money supply coming down sharply is something that a lot of folks seem to be worried about. And you notice where the rapid expansion occurred. It occurred on the watch of our good friend Mr. Powell. And so this is his legacy, and everybody else, all the other. If you go to the next slide, that kind of divides up in my crude way of the various Fed heads. And to the left of the shaded is Alan Greenspan. Alan left these folks with a velocity of money that was going up, and everybody's now inherited a velocity of money going down. And I had a couple of trading mentors way back. Jerry Jordan was most noteworthy, and he basically said that money supply up without velocity up doesn't give you inflation. It gives you a worry about deflation. And there's some suggestion that certainly in Europe, this is even a more dramatic data series as it's calculated. I think the Fed was in a total panic back there in 2020, and there was red telephone conversation, and they said, we got to do something because this is really bad. And they did something. Now, whether that is going to lead to real inflation or something to do with the broad asset allocation into things like gold, which would be, I'm in very close to Tyson's camp. Gold has been bouncing around for a long time, and it's got options on the upside that are pretty significant. But you've got three Fed heads who have inherited this chart, and I think they talk to each other, and I think they're still worried. Next slide, please. And that's an expansion of that sharp drop in velocity that then has been stabilized. And it's slightly increasing, but in context, it's got a long, long way to go. Next chart, please. That's the long-term view of what was going on, and you can kind of plug in there where Greenspan was operating. And notice the Greenspan, the low in the 80s, during his entire tenure, that's what he worried about. When he used to come to Putnam back in the early 80s, the older managers would pull me aside and say, he's an interesting guy. He was at Townsend Greenspan before he was Fed chairman. And he said, but he's a one chart guy. And I said, oh, and he said, yeah, he just looks at scrap steel. If scrap steel's going up, they have inflation. If scrap steel's going down, you have deflation. And I do not have a chart of scrap steel, but I've got a guess that is probably still a worrisome chart, but that's a guess. I could be completely wrong. Next chart, please. This is probably the most important financial stock in the country right now. It's not JP Morgan. It's not Bank of America. It's not State Street. It's BlackRock and Larry Fink. And he runs this whole thing supposedly. I found one great article done a long time ago. He runs the entire firm off a computer called Aladdin. And Aladdin obviously has the association of something with a magic lamp. And the story that goes with that was that Greenspan, when he resigned, went to London to be by himself. And he was a sort of a antique guy. And he went into an antique shop and he saw what looked a little bit like a lamp with something inside. So he bought it and took it back with him. And that night he rubbed the lamp and out came a genie. And the genie said, well, sir, you can have one of three things. You can have infinite wisdom, you can have longevity, or you can have all the money in the world. And he said, I'll take infinite wisdom. And the genie said goodbye, got back in the lamp and disappeared. And the next morning when he was shaving, he looked into the mirror and he said, should have taken the money. But that's possibly because he presided over something to do with money supply growing during the entire period. And I think Larry Fink is scared to death. And that's why he runs around with all this conversation about ESG investing, which is, we can debate that another day. But that the BlackRock chart is a bond chart, not a stock chart right now. So next slides, we can go fast now. No more stories. Dick says there's no recession. Dick's bottomed in 2020. How can you be running a retail giant, brick and mortar, with all the problems of COVID and staffing and have that chart? Um, there is a segmented recession out there, but it is not in the area that Dick's taps into. And I think that correlates to a lot of different parts of the economy. Next chart. This is the how to short the cues. You don't have to worry about margin calls or anything else unless you buy this on margin. I would not buy that chart. I would like to be able to buy that chart. Dean LeBaron would be.
That's the short cue. That's the inverse.
That's right. That's right. And so if you've got the Stephanie Tomboy, we're going to hell in a handbasket scenario, you should be long this chart. And if somebody walked up to me and said they had their retirement fund in this, I would, and if I liked the person, I tell them to get out. And if I didn't like them, I tell them to double up. But that's a whole nother story. So next chart.
All right.
There we go. This is the equal weight Qs are up about 28% from that October low. It's not a year-to-date market, it's an October low market in the world of Craig Johnson and Me Too. Next chart. The cap weighted NASDAQ is up 25 to 26%. Everybody I've seen on CNBC, Bloomberg, and occasionally Fox, because Fox, I don't know, unless you're worried about the border, it's hard to watch Maria all the time, even though I like what she does. And some of the folks there do a pretty good job. Everybody is saying that this market has been dominated by the FANGs. And the data says that's not true. The data says that everything went up inside the NASDAQ, not just the handful of stocks that get a lot of publicity. Next chart. State Street, local, there are very few kind of Boston-based financial firms anymore. State Street's one of them. State Street was a custodian in my heyday when I was managing money in various places. It now is an ETF purveyor, but something's going wrong there. That's a terrible chart. It looks like, God forbid, it looks like a chart of a regional bank. So what is that all about? And go to the next chart, please. And we got a couple of bond charts, only because I don't think we get out of trouble in whatever is in the backdrop. By the way, if I were talking to the old defined benefit world, you didn't walk into meetings and BS people because they'd fire you. I once managed money for the Southern and Northern California meat cutters, and after the meeting, the head of the committee, we met in one of those conference rooms at a Holiday Inn on basically metal chairs, with paper coffee cups and donut holes. This was not high end entertaining. He shook my hand, turned his hand over, and he had 3 missing fingers. And I said, "You're going to do a good job for us, aren't you?" Well, that's a good metaphor for the defined benefit world as opposed to the defined contribution world, which is who could have known it's not our fault. This is a stabilized chart of the 10-year. This has got to be the kind of ETF that all the asset allocation wealth management folks at, name the firm, are using. But better. It's being saved by something. Next chart. By the way, that chart shouldn't look like that. That's the longer term view. That view says the Fed is not through. I would say that if the best way to see that as having a rally up to the little intermediate line and then breaking to a new low is the Fed's going higher. It's the Jim Bullard, we're going to 550 on Fed funds case, which is now a horror story in the minds of most people. Next chart. And Schwab is now a regional bank. So is this redefinition or is this contagion? If you put together State Street, BlackRock, Schwab, and go to the next chart, there are a couple more that look like that. And whatever ARC was, realize what a disaster this is. This rivals the dot-com fiasco of the 2002 period. I mean, this is they everybody who's inside that ARC fund on the downside is probably laying people off left and right, and those are folks that are supposed to be out in their 30s buying houses with mortgages, and I don't think that is a good chart to match with that behavior. Next chart. This is now just a view of, this is the futures of the NASDAQ. So I've circled the two highs that have to be exceeded to really begin to build this October low into something more than a reflex reaction. Next chart. Next chart is the S&P future. We're using the micros just because it's a little easier to see. Again, you can see you've now taken out those two intermediate highs that go back not too far. And next chart. There's contagion locally. It's the largest bank based in the Boston area, and it looks like Schwab, and it looks like that bond chart, and it looks like BlackRock. So something's going wrong. These guys, as best I can tell, have none of the problems of Silicon Valley Bank or First Republic, but they were being treated. It's back. That, by the way, is the offering price to when they went public some years ago. So you've wiped out all of the gains of the capital raising of this bank in a matter of months. Next chart.
I'm going to interrupt you.
Yes.
I'm controlling things. Not sure whether the comment's worthwhile, but I heard that, regional banks are down from 14,000 to 4,000. And now you have Apple is getting into a money market business. And one of the issues that started the whole Silicon Valley Bank was they had huge deposit bases, and then they mismatched their duration or idiotically managed with their portfolio. And so there were two issues. One is a duration mismanagement, but secondly, it was the loss of capital. And that suggested to me, because they're also Apple, brilliant firm, working with Goldman, also another firm that is brilliant, is working together to attract that money. And I'm to the degree that there is a systemic pull of money away from regional banks, I see that as a legitimate concern.
Sure. Yeah. The thing that you worry about, here's UBS. Why? How can UBS look that good, given that they graciously saved Credit Suisse? And that in the Swiss banking world, this is like the embarrassment of all embarrassments that they failed Credit Suisse. So whatever's gone on in there, we're going to have a long time to try to figure out what it was. But the rumors were that Credit Suisse was always very active in creating creative derivatives of all sorts, and that what usually sinks these ships, so to speak, I think we use the letter CCS, counterparty, co-party, or settlement problems of some kind on a massive scale, meaning somebody doesn't pick up the phone one day and say, "Oh, yes, we can do that." There's nobody there. Next slide, please. And this is probably still where the problem is in the US system. That's the mortgage-backed security ETF that was plummeting when it was saved with that spike of volume. Somebody saved the system in October. That's my thesis. And whether that was a good save or a bad save, I'm not sure. I'm not sure it's World Cup soccer or it's National Hockey League stuff where the goalie stands on his head, so to speak, and they win the Stanley Cup. We can only hope to find out. Next slide. And last observation is, and I didn't put the charts in because they'll depress everybody. If you had made a simple asset allocation move into international in October, the UK and the German ETFs have been little rocket ships. ASML, as I call it, ASML, the semiconductor company, has been just like NVIDIA, but you could have bought SAP and you got a 10% kicker in the currency. And Dean LeBaron, if we had missed that, he would have been really angry and there'd be no bonuses this year because that was a contrarian play that was right out of the textbook. So what is that all about? Because I still think that Europe, every time I read something and listen to Christine Lagarde and read transcripts, it sounds like they just have endless problems over there. Anyway, that's kind of the overview. I don't think that the earnings are going down. And I don't know what is going to drive the market through the next layer, but the movement and meta suggests that there were a lot of shorts out there and short interest in the treasury. The 10-year treasury apparently is at record levels right now. And the 10-year treasury has gone 407 to 340. So go figure. Anyway, thank you very much.
Thank you, Richard. I'm going to go to Jennifer Warren, coming from Texas, somebody who is an academic who writes. She looks and understands the energy space well, but also understands the whole energy transition. And she's going to talk about some of the trends that she is seeing. And we'll chat for 5 or 10 minutes here, and then we'll have some questions.
You can stop screen sharing.
Okay.
Thanks.
Let's see here. There you go. Actually,
Okay.
some benefit to that.
Yeah. Okay. Let me get my view up here. Okay. So I just want to start with saying, well, first of all, I have a slightly academic background, but actually I have a communications consultancy that focuses on energy. And I'm also doing some new market making ventures, and it has to do with matching capital with some of the sustainable investments that I run across. And so really, I'm sort of more of an entrepreneur, but and I do a lot of investing. But anyway, but I'm grounded in academic thought, and I'm careful about what I say and how I say, and that I have, you know, the right metrics generally. But I just wanted to say, first of all, in the last week, I've been at an EarthX e-Capital Summit, which was matching capital allocators to all sorts of projects, whether it's clean tech, oil and gas, ag interest, circular economy, you name it, it was there. So I saw a real wide range of what's happening in the transition and in all the innovators. So that's one. And a lot of those are, you know, VC type investments, but, you know, eventually, you know, we're going to see that publicly at some point. The other thing that happened, I was with Toyota and Chevron in their rollout of their renewable gasoline. So that is light duty. Chevron has been working at heavy duty sustainable fuels for some time. They have paired with Toyota. Toyota has a hybrid that's either, I think it's coming out. And so what they were doing is testing this renewable gasoline. Toyota doesn't pay a dividend, but its long-term growth is steady. You know, it's just a real steady play. And they're very much focused on affordability and reliability. I think it's a very interesting and stable type of car play versus, I think, some of the others that are more subsidy driven and guns a-blazing BEVs, battery electric vehicles. I think the hybrid will win a larger share of the market over time. There will be battery EVs. It's going to be very much segmented market, diverse market on all that. And it is connected very much to the energy mix and the energy transition and the idea of electrifying many things, which it's just not going to happen like sort of the more green leaning folks think. There is no path to full-blown electrification. Won't happen, largely because of energy density, for one, unless we're in a total nuclear fusion world. That's a whole nother story, and that's way out. And then the other other thing I touched that was interesting, this was yesterday. I was in a symposium all day long with E&Ps, a lot of them in the Permian. Permian, produces 5 to 6% of global oil supply. All the big players are there: ExxonMobil, Chevron, Pioneer, Diamondback, Katera. I'm sort of going through a top 10 roughly, EOG. And so at the symposium, it was very much talking about how oil and gas is going to interplay with the energy transition. And I've been talking about how, they're in good shape with their balance sheets, they're making money, and they're going to be the ones, doing the hydrogen, doing the CCS initiatives that are being funded by, the incentives in the IRA legislation. They are taking advantage of that, now doing projects. We've seen many announcements. And there is real evidence this is happening. So at this conference, I think it was the number 2 from the port of Corpus Christi was there, and the port of Corpus Christi is now the top crude exporter in the United States. 2.3 million barrels a day go through that port for export. Countries that import crude like and want US crude. That is an interesting statement. There's a lot to that. That's a whole conversation for another day. And the other thing about this port is that it is going to also be ramping up LNG exports. They're doing some upgrades to that. Right now, from what I understand, if memory serves, because I heard a lot, is that Long Beach is the one port that can handle those really big LNG tankers, but Corpus Christi will be able to do that, and that's a good thing, because a lot of the natural gas is coming through the Gulf Coast because of the issues with the Marcellus, with the pipeline issues. They can only get so much gas out. I mean, they do a tremendous amount of production in the Marcellus, and that's not going to stop. But right now there's pipeline constraints. And so there's a lot of gas that's coming from the Haynesville and the associated gas coming from the Permian and Eagle Ford and all that. So those are things to watch, those flows and the players in those flows, for one. Just a quick note about, there was somebody there from Rystad Energy that talked about the strategies in the energy transition related to ExxonMobil, Chevron, Shell, and BP. And I've been talking about this on my videos. I have a YouTube channel, by the way. I've been talking about this since last November. I have been highlighting these firm strategies as such over time. And we know that the US majors were a bit slower to do some of the things that BP and Shell did, but BP and Shell are having to reverse themselves. And, because, there's very much the recognition since Ukraine that we are very much, fossil fuels aren't going away anytime soon. And they still provide the energy density that the whole world demands. And, and that is growing still, even though the United States and Europe, plateaus with their consumption. The rest of the world is increasing their consumption. So that's something to note. And that and so in this conference, I was listening to scientists, geologists, E&P people. I was listening to some of the understory behind CCS and hydrogen, because obviously there's a lot of announcements with that. And I'm trying to work out what the investment rationales are on that and where the money's going and where the puck is going. One thing I can say that I heard was that hydrogen hubs, they stand alone without the IRA monies. So that's interesting. And the Port of Rotterdam and Corpus Christi, Gulf Coast, are going to be big hydrogen hubs. There's a lot of money going towards this, a lot of firms, big firms investing. One name that I heard was Talos Energy. Talos does offshore production, and they were partnering more with the port. And this interesting point was made that while there's a ton of interest and attention paid to onshore shale production, absolutely going to be happening for a long time, especially when you marry it with enhanced oil recovery over time. We know the Permian is going to be plateauing for like 3 decades at some point. It's going to be enhanced oil recovery making that happen. But what was interesting was that, there is still going to be offshore development. We've kind of been offshore, a bit, focusing on onshore, but that in fact, there may be some of that movement in the future as some of the, production is hitting, walls with going to tier 2 and 3, and that. So there's going to be need for some offshore production as well. More increasingly, there will be attention there, even though it's an onshore world. The other thing I can say, Shell will be doubling down on LNG in the future too. They have a lot of capacity in that area. CVX, Chevron, the renewable fuels, the sustainable fuels is really an interesting and good segment. And I think that's going to grow, especially in an ESG concerned world, which I can say from attending EarthX, the idea of ESG, love it or hate it, whatever you think about it, and we won't debate that today, the concepts behind it, the sustainability principles, not going away, decarbonization, not going away right now, and for a while, unless we come up with something way different and better as a metric. So the decarbonization drive is well in gear, oil and gas playing in it big time. And so they're spending money on it. They're spending money on CCS. There's a lot of frontier work being done on CCS, and I can't go into the geology of all that today, but it's really fascinating. And I started wrapping my head around that. What is real? Who's going to make it? But one quick last thought on some of this, where do you invest? Obviously big oil, I have a number of those stocks, solid, but there's a lot of players, I think, in the future that are going to emerge differently, whether it's mid-size or small cap firms like Tyson was saying, that either they're going to get acquired by larger rival, competitors, or they're going to partner. And so that would help their stock. So I'm starting to try to look at, what are some of these smaller names that could be beneficiaries of this energy transition, because there's really an interest in collaboration and partnership like never before. So this transition is real. We are where we are, but we're looking ahead. So it's a really dynamic time. And the incumbents have a lot of, good years ahead of them, obviously, many decades. And one quick thing I'll say about the minerals and the EV stuff. Okay, so I've talked about the headwinds of minerals, critical minerals. We've heard about it. We know the geopolitics. There's a lot of challenges. There are going to be, and this is from scientists and the geologists camp, and I've heard it from all camps. The minerals challenges with all this, with EVs, solar, wind, all these things we put in iPhones, all of it, there are going to be challenges for the next 10 to 20 years with the mining. And a lot of the low-hanging fruit mining has happened. I heard that from a geologist. That's interesting. Nobody's talking about that. So what does that mean? And also mines, it takes a long time to get a mine online. It can take 10 to 15 years to get mines online. So with this, trying to change up supply chains, that's one issue. And then the charging stations are a challenge. And there's a lot of money for those. There's like $500 million earmarked for Texas, and they're going to build a lot of these charging stations, but whether they get used and how, I don't know. I'm sensing that it's there really needs to be a better market mechanism for this. Let's see. Let me see if there's anything else really big. I think that's it. And I think, Tyson, though, I think your small cap idea and your emerging market idea, I mean, I think it definitely interplays with some of my energy investing, energy transition thoughts as well.
Thank you. So we have a surprise visitor. His name is Robert Gibbs, and he and I work together on a company called Optima Process Systems. Robert is a octogenarian, and he's brilliant, and he has worked on energy projects for 6 decades, and he's on mute, but he knows as well as anybody what the trends are in energy. So Robert, if you can get off mute, we can have you. I'm asking you to unmute. Bob, can you hear me? You're muted. You have to unmute yourself.
I've got to sign off. Sorry.
Okay.
I wish I could
Thank you so much, Jennifer.
Sure. Sorry. Thanks, everybody. Bye.
So Bob, actually, Jennifer will be joining our Optima meeting on Monday.
Look forward to talking to you then, Jennifer.
Tell us what you're in 3 to 5 minutes, which may be impossible. So your views in terms of trends in energy, where do you see things going? You're in Europe now, or you're always in Europe, I forget. Are you in Spain again? But that doesn't matter. Tell us what your thoughts are in terms of trends in energy, or observations in terms of just what we said.
I was watching your presentation, very interesting. And unfortunately, I'm not in the finance sector of the business. I'm more in the doing end of the business. And my experience has been in exploiting natural resources, mining, oil and gas, and what have you over the years. And there's a lot of factors that come in. Looking at hydrogen and things like that. Hydrogen obviously will be the long-term bet. However, the cost still is 8 times more than solar energy and wind energy. And nuclear also, these new small plants that they're looking at, they've got a 10 to 15 years lead time. And the political risk and the turbulence in the market, I don't see anybody plunging and putting money in at the moment. So I'm looking at the practicalities of large capital projects. And I do concur, the life of hydrocarbons is going to go on, because if you look at the developing areas where cars are being sold, they have no means of supplying electricity. So that's a no-no. That's just in broad terms. They're the observations that I have to offer today.
Well, thank you. Bob was involved, I believe, in the kind of overview and setting up of all of the drill rigs in the North Sea when the price of oil went up, and he has worked in every continent worldwide. But do we have any questions here?
Well, the interesting thing, I think, really is, if you look at batteries, China produce 80% of the electric batteries. They only have about 6% of the available minerals required for batteries. Australia have got the largest reserves of lithium and 60% of the world's supply. They don't produce any. And there is a shift now where people are looking to move the manufacturing of the batteries to where the raw materials are. However, they're all unstable areas, and they've got political problems, they've got logistic problems, and will people put a risk in those areas? What my experience is, putting together cost models, looking at all the factors, looking at the time, and at the moment, the companies I'm working with are mostly the majors. There's a reluctance with the political turbulence in the world for them to go ahead with any of their major projects, because the political risk is undefinable.
Well, I guess it sounds like you're positive on Australia, but you're not jumping into the Sudan.
No, I'm not necessarily positive on Australia. I'm just saying that's a fact of life. That's where the lithium is. And the other area where you've got lithium is in South America, the triangle in the south, Argentina, the adjacent countries, and Bolivia. Unfortunately, they now want to develop and produce the lithium into batteries. And Mexico too. Mexico have got something like 12% of the lithium. And what the people are looking at is it worth investing in those areas and what are the problems? You know, projects rely on three factors: technical, economic, and political factors. The technical and the economic considerations are there. The political ones are not, because they're unfamiliar areas and people are not very comfortable. That's the feedback I'm getting at the moment. But I'm not working on the political models, but the projects I have been working on, those have been the considerations that have caused the decision makers not to venture into those areas.
Walter Harrison, do you have any thoughts or comments?
Well, not really, other than everything coming out of the White House is so wrong-headed that it just it makes me sad. I misunderstood something that Bob said, or didn't quite get it. It sounded as if he said that solar and wind was efficient. And
no, I'm not saying they're sufficient. The cost has gone down 80%, and the cost is a lot less than the other avenues, something like 8 times cheaper at the present moment.
Well, you're saying you think the cost is 8 times cheaper than hydrocarbons?
Than nuclear or hydrogen.
Well, nuclear. I mean, I guess your thinking there is just because of the time it takes to develop it. Maybe I'm not.
No, it's the actual energy you have to put into the production of hydrogen is disproportionate. But still,
hydrogen.
If you're going to use solar and wind as a source of energy, which is virtually free, then you've got the problem of storing it and distributing it and putting that network in. And a lot of considerations on the political, where do you put it and what is the risk? With the Ukraine war, etc., that has really raised considerations that weren't there before. And that's the problem as I see it.
Okay, I think I misinterpreted something then. I thought you were distinguishing nuclear from hydrogen.
No, I'm not. I'm saying that, the cost of nuclear and the time, it is still a lot more expensive than other forms of energy. And the reality is, oil and gas, you can get it out of the ground, and I think it's going to go on a lot longer, and the price can come down tremendously. None of the other forms of energy can compete.
Oh, I agree completely. But once again, nuclear, I'm not talking about getting nuclear hydrogen. I'm talking about, our current nuclear reactors and the smaller ones, I think, aren't they quite efficient?
They're efficient, and they are. There's a lot of consideration going into them, but the reality is that the numbers that are coming out, it's still 8 times more expensive than wind power and solar energy.
All right. Well, so be it. I mean, I'm a complete hydrocarbon guy, but I don't think wind power and solar, in part, came down because interest rates came down, and interest rates have now gone up. I mean, you know what it takes to build one of these windmills? They're crazy, and then they don't develop steady stuff, so they've got to have backup anyway.
So let me just jump in here.
I concur with you, but I think that what they're looking at is that they're intermittent and that they're not consistent. So if you can take that source of energy and store it economically, and one of the ways to store it is hydrogen, that looks an attractive route to go. However, the people I've been working with and talking to, due to the political risk, are now very worried about the exposure. You've probably seen that the Russians have been mapping out all the wind power in the North Sea and around, and they've been also sabotaging the subsea cables. That's causing a lot of concern.
Mhm.
So my concern or my question is, you're saying that wind and solar is very cheap. What my
No, I'm not saying it's cheap. I'm saying at the present moment that you cannot compete with the cost of that and the
but
time scale to
these things
bring it
have
on
been.
stream.
But how much, or how quickly can we move the needle on it? Because my sense is that we don't have enough minerals, and it will take 20 years till we have enough renewable energy to really push back on oil and natural gas. Is that correct?
Well, I don't know. If one looks at the UK, I was rather surprised to see that at the moment they've got about 40 to 45% of their energy is coming from renewables,
Wow.
which is quite a high percentage. Denmark are way ahead of that even, but I'm not an advocate of any of these systems. I'm just saying that the studies that I've been working on over the last 4 or 5 years, that still there's a lot of money going into renewables and there's a lot of money going into oil and gas. And I think that what you'll be looking at is more and more investment in hydrocarbons and combustion engines, but trying to reduce the emissions. And I think that's the way things are going to go.
Well, I'll tell you, that makes me a little more bearish with regard to EVs. I think that they look like the panacea. I thought Jennifer made the comment that hybrids will advance. I've read that. It'll be an interesting future. I'm not sure whether I can disclose what you had said about the natural gas project in near Israel, or
Well, the natural gas, the problem you have is that most of the deals are done politically and they're done from government to government. And the cost of an LNG project and the time it takes is you've got to build the LNG facility, you've got to build the transport system, the ships, and the gasification. So there's three elements. And the time it takes to bring those from day one to fruition is probably 8 to 10 years. And that doesn't solve the immediate problems you have now. But that's a problem. I mean, I think you'll be looking at transport of cryogenic gas or hydrogen, which is minus 450 degrees. And you will be looking at superconductors to take electricity. But they're not here today. Those are the forms of energy they're looking at that could be viable in 10 to 20 years' time. So if you're looking at investing in LNG and it's going to take you 10 years to start to get a return on your investment, are you going to put money in when you think something's going to take over? I don't know. I'm only looking at the factors and the criteria that's coming up and modeling them.
well, this meeting is going on now an hour and 15 minutes, so I'm going to make the final comment. But what I was looking for, and I appreciate the fact that there are these problems of very long lead times for energy alternatives, is that the planned project, which was going to put an LNG facility in Egypt, was canceled for.
Well, it's not cancelled. You've got energy in the Eastern Mediterranean, Israel, and what have you. And to make it viable, it was planned that Egypt would also come in, and they would put an LNG facility in near Alexandria to take gas both from Israel, Eastern Mediterranean, and Egypt. And the plan was to bring a floating LNG production that's owned by Philips into the Mediterranean. That's still there, but it doesn't look as if it's going to happen.
Well, I was going to say that the proximity and the increased hostility you're seeing in the Middle East may actually been a factor in their decision from a geopolitical perspective to start to fade.
Well, I'm not looking at the geopolitical. I'm looking at the problem of where it is and the factors
But
that come.
I am looking at the geopolitical to emphasize that geopolitics are now a factor with regard to where people want to do mining and where projects are going forward. And as this group broadly is in an investment group, kind of understanding what's driving things and what isn't is, I just want to.
But I think that the other alternative is to take a pipeline from the Mediterranean through Turkey and through that route. It will take a hell of a long time to build that, 18 years probably. So that is the other route, and that's the preference of some of the people. However, politically at the moment, none of the players seem to be interested to go forward. They've paused because now you've got Sudan and what that does to Africa. The political risk is what is causing people to reconsider what their options are.
I'm going to wrap
I
it
mean,
up
you've
here.
got you've got in West Africa the possibility of taking the gas pipeline that's been on the cards for a long time and then bringing it through the Sahara into Spain, where you've already got pipelines, etc. However, the political instability of all those areas has made those unattractive.
The final comment I'll make was what Rich Gula was observing, and that was that a earnings rollover, which is what I've been very concerned about as it relates to the market on a going forward basis. He, at least today, does not see that as problematic, though I think that people in general are looking for an earnings slowdown or recession, an economic or earnings recession. Anyway, I want to thank everybody and our speakers, Bob Gibbs, Jennifer Warren, Richard Gula, and feel free to reach out if you have any questions. Thank you all.
Thank you.
Thank you, guys. Very good.
Thank you, Tyson.
Thank you very much, everyone.